Hello and welcome to another video. Today's video will be on the financial analysis. We'll be looking at the relevant ratios and calculations you'll need to perform a financial analysis. These are not exhaustive. You can add more, you can have less, but these are the ones we'll be looking at today, as well as importing these ratios, completed ratios from investing.com to your Excel, where you can then use them in your presentation and use them as a form of analysis to compare them to whatever you'll be comparing them to. Right, so first up we have EPS, earnings per share, which is the amount of profit assigned to each stock of the company. The formula for that is net income after tax divided by total shares outstanding. You won't necessarily have to do this calculation because it will be provided to you automatically, but it's just important to understand where these numbers come from. A high EPS generally indicates more returns to the investor in future, and a low EPS would signify fewer returns in future compared to similar companies in the same industry. This is not entirely exhaustive though, because a high EPS could often mean that there would be some kind of correction in the market on your specific security, and that's something to take into account. It's always important to look at various perspectives when you are assessing a company and assessing the EPS. Basic EPS is the total shares outstanding, whereas a diluted EPS takes into account the shares that the company holds that can be issued in future. This, of course, depends on your relevant industry and the nature of the company and whether they do have holding shares that they can issue in future. Trailing EPS uses prior period earnings. Current EPS uses current period earnings, current fiscus earnings, and the forward EPS uses projected earnings. Projected earnings is something we'll talk about in a later ratio, so just keep that in mind, that the EPS is quite useful and will be quite useful for quite a few of the ratios that we have going forward. Now, the price to earnings or PE ratio, something that we will have seen in our academic work especially, is the ratio of a share price to the earnings per share. So earnings per share pops up again, and the formula is share price divided by earnings per share. Compare this to indices and companies in the same industry to figure out if it's good or not. The forward PE ratio calculates the PE ratio for the following 12 months. For that, you'd be using the forward EPS. The trailing uses for the previous 12 months. For that, you use the trailing EPS, of course. The lower a PE ratio could mean that the stock is fairly undervalued. This, of course, could be case sensitive, but a good measure would be reading into the forward versus trailing, in that if the forward is larger than the trailing, there could be a decrease in earnings, and if the trailing is larger than the forward, there could be a increase in earnings. But of course, the PE ratio is fairly case sensitive, and you'd have to find out what it means to you. Different investors have different sort of opinions on it, and yeah, you just have to find out how important it is to you and how you would use it best in your analysis. Right, so next we have the return on equity, or ROE. It's very much an accounting ratio. Is the ability of a company to generate profits based off the investments by shareholders. And the formula for that is net income after tax divided by shareholders' equity. That would be average shareholders' equity. An ROE of 13 to 15% is seen as healthy compared to other types of investments generally. So you'd compare that to your banks or any other kind of place. You could take an REIT, real estate investment trust. That would sort of be your comparatives, in that it's other places you could be investing your money. The ROE is an efficiency measure, meaning that it's a measure of whether a company would be able to increase profitability without additional capital injection. So that's how well they handle your money. They have an explanation of the average shareholders' equity, which is shareholders' equity at the beginning of the year plus shareholders' equity at the end of the year divided by 2 to get your average shareholders' equity. The risk is that companies with few assets would have an increased ROI, of course, because there's not much capital injection. So that's something to be aware of depending on the company you are looking at. So next we look at the price to book ratio, PB ratio, which is a comparison of the stock's book value to the market value. Quite an interesting ratio, as you can hear by the description of it. The formula is the latest closing price divided by the previous quarter's book value per share. Okay, that's quite straightforward. So how to read into the price to book ratio? Generally, a price to book ratio of less than 1 would indicate an undervalued company, which is a good buy. Not good buy as in goodbye, but a good purchase. That's a good investment. And a price to book ratio of over 1 would be slightly or more aggressively overvalued, which is something you'd want to stay away from, because then you would not have as much of a growth in the share price. It's the assets comparison to the market value. That's quite a good explanation for what a price to book ratio is, as it says price to book. It's more significant with companies that have high liquid assets. So you'd be looking at your balance sheet and your current ratios to see whether the company has high liquid assets, and you know that this ratio is more important for you and your specific company you're looking at. But then conversely, the risk would be that companies that have high fixed assets and lots of R&D expense, you can think of a few industries that have high R&D expenses, it wouldn't be useful to use the price to book ratio, of course. So next is a bad boy that everyone should be familiar with from the CAPM formula, beta, correlation of a stock price with its benchmark index. It's a measure of volatility versus the benchmark index. The formula is the covariance of the stock and benchmark index divided by the variance of the benchmark index for a set period of returns. These are weekly. So on Excel, it's the slope function. You have your weekly returns lined up evenly. So for example, 10 weeks of each, and you can do the calculation like that. When beta is, well, first of all, beta is always between -1 and 1, as we should all know. When beta is more than 0, it's positively correlated, and that would mean that it is more volatile than the benchmark index, or the security is more volatile. When it's less than 0, then it's negatively correlated, and it's less volatile than the benchmark index. The stock price is less volatile. This, of course, I'm sure everyone knows about the technicalities with beta, that being the risk and return relationship, which you measure with in terms of your volatility. So, you know, more returns, more risk, less returns, less risk. Of course, volatility refers to risk. That's the price fluctuations and so on. So a few examples of benchmark indices would be Dow Jones Industrial Average, S&P 500, Nasdaq Composite, the MSCI indices, which you have for a wide range of markets and countries and so on, and the IBI, which is the International Benchmark Index. These are all, of course, readily available across the internet. The various forms of benchmark indices, you can download the returns and get to work. So next up we have the price to sales ratio, PS ratio. It's a comparison of the stock price versus the revenue of the company. The formula is share price divided by per share revenue, or you could also use market cap divided by income or revenue. It's basically saying the same thing. They would come to the same number. You don't need to worry about the differences. It's just the amount of shares are multiplied or divided, whichever way you're working towards. With the price to sales ratio, a lower price to sales ratio is a good indicator of an undervalued stock. A higher PS ratio would be an indication of an overvalued stock. So you should know which one you should be looking for. It's undervalued. You should be looking for undervalued securities to buy. If the price to sales ratio is between 1 and 2, you're looking at a good investment, but if it's below 1, that would be best. But do take note of the disclaimer that this is also always case sensitive. You should compare to similar companies and then work from there. The one problem with the price to sales ratio is that it does not account for expenses. You'd have to look at your margins for a sort of guide on whether there are a high amount of expenses or a low amount of expenses. So basically the logic with the price to sales ratio is that a lower price to sales ratio would mean that an investor would pay less for each unit of sales. So you'd be paying less than 1 Rand for 1 Rand's worth of sales, which is a positive. So then starting on the dividend, boys, we will start with dividend payout ratio. We will be discussing this in a little bit more detail when we do dividend yield in the next one or two. It's basically an expression of how much earnings are paid by dividends. There are two possible formulae you can come up with. Either dividends paid divided by net income or dividend per share divided by earnings per share. It's very similar to the one we done previously, where you just either multiply by the amount of shares or not. The main considerations would be company maturity or growth. Established companies could afford to give higher percentage dividends due to less reinvestment. Growing companies would opt to retain income to reinvest into the company and so that they could grow and then one day, issue more dividends. It is industry sensitive, however. Certain companies do rely on income retention and others would distribute dividends much more liberally. So look at the industry you're in or industry or companies in and work from there. It's also important to look at trends. So a steady rise over the dividends over the years is very good because it shows sustainable and stable growth. If dividends are erratic and fluctuating, this is not really that good because it shows inconsistency and possible problems with cost controls. There are a few variations to this ratio. You can get the augmented payout ratio, which takes share buybacks into account. If the company did not issue any buybacks or does not plan to, you don't need to worry about that. And the more accurate version of the dividend payout ratio would remove Class B dividends from the equation. Class B dividends are preference dividends. And those would also be a fixed rate of dividend normally. So for example, 10 Rand per share, for example, they would not really fluctuate or change. And then just conversely to this ratio, you have the retention ratio, which is the opposite. It would basically be, to calculate, it would be 1 minus the dividend payout ratio would be your retention ratio. It would measure how much of earnings are retained and reinvested by the company. This is quite an interesting figure to look at for certain companies. But then again, remember that it's all case sensitive and you would have to assess the nature of your company and the industry. So then we have the dividend yield ratio, which is what the dividends are compared to the share price. This is different because it's more about the share price and less about the earnings. The formula for this would be annual dividend per share divided by price per share. You'd use the previous full year financial statements to calculate this. It's expressed as a percentage. Basically what this is the simple rate of return in cash dividends. It would have similar considerations to the payout ratio that we discussed previously, but the payout ratio is more widely useful because it says a bit more about cash flow. And it's important to read this ratio in particular with the current ratio, which refers to the liquidity as well as the payout ratio. So it's important to get context when you're reading into this ratio. The dividend yield ratio would be specifically important if you are a dividend investor. So you'd have to think about, why am I investing? What are my goals, or what am I looking to achieve with this investment? But if you are not a dividend investor, you wouldn't really need to worry too much about the dividend yield. It's something you could kind of pass over. So next we have the projected earnings growth ratio, or PEG. It's the cost of each unit of future growth in revenue. So this is where our EPS, our forward EPS would come into use. So it's the PE ratio divided by the projected EPS. Generally, the lower the better. It would mean that future earnings are bought at a discount. Buying things at a discount is always good if you plan to sell them in future or you want it to grow. A PEG ratio of less than 1 is seen as great. It would kind of be industry sensitive, but I think that is fairly good. Yeah, like I said, it's industry sensitive. You'd have to compare with similar companies as well as the industry. This is very important that you read the PEG ratio with the PE ratio. So yeah, where you can get the projected EPS is places like investing.com, which we will be discussing in the next slide. Yeah, places like investing.com, there are quite a few analysts for larger companies that do put out their projected earnings for certain companies, but for smaller companies you find what you're looking for on like an investing.com kind of site. Right, so we'll just be copying in the ratios now from investing.com to Excel. We've basically done this before. The only difference is that now you need to make a short free account on investing.com in order to be able to download the ratios. Yeah, we have quarterly, TTM, which is trailing 12 months, which means the previous 12 months to the month we're currently in, and fiscal year and 5 years. So fiscal year is financial year and 5 years is the previous 5 years. So we're just going to press download Excel. Not necessarily that you put it in Excel, but for this we will be putting it in Excel. So wait for it to open up, and there we have everything copied over, company and industry and what the ratio is. We're just going to cut that out and put it on our own Excel sheet where we have all our other financial ratios. Oh, there we go. We'll put that under TTM. This would be from August last year to August this year, is essentially what TTM means. We're going to copy in the fiscal year as well. You can download all of the ratios, but for this video we'll only be doing the 2 because I think it covers a wide enough net, and you could possibly get everything you need to read on all your ratios from just these 2 alone. But you can also download the 5-year and the quarterly performance if you want to read more deep into everything. So there we have everything. Yeah, everything we've discussed, company and industry. Thank you very much for watching. Have a good day.